A lot of people are talking about the economy. Cara Esser is a senior analyst on Morningstar's fixed income research team. She's published hundreds of articles on investing in closed-end funds. Can you share your view of interest rates, where they may be headed, and why it's important to closed-end fund investors?
So far in 2016, we've seen interest rates go up across the curve, and I think that trend is expected to continue into 2017. And this will affect closed-end funds in a number of ways. First off, bond closed-end funds will be affected by the inverse relationship between interest rates and bond prices. So interest rates go up and bond prices go down. That will have a negative impact on total return for closed-end fund bond investors. In the longer term, though, rising interest rates should be a positive for bond closed-end fund investors because newly issued bonds will have higher coupons, and those higher coupon bonds will be included in the closed-end fund portfolio. So we should see over the long term a benefit here to rising interest rates, but there will be some short-term pain. In terms of inflation expectations, which also goes along with interest rate changes, people have been expecting that inflation will be on the rise going forward. So that will have a negative impact, of course, on bond funds as well, because inflation eats into the total return of your portfolio. Additionally, there may be an impact on the IPO market in terms of rising interest rates. So in the last few years, we've seen a trend of fewer and much smaller IPOs every year. Last year, in fact, we only saw 8. And most of them were less than $250 million in assets raised. So this is definitely a trend that's likely to continue into the future because higher interest rates will make it a little bit less exciting for bond investors in the closed-end fund market to snap up those IPOs.
Final thoughts for closed-end fund investors who have bond portfolios. Is this a good time or a scary time for them?
I think it's a mixed time for bond investors. It depends on what you want to get out of your bond portfolio. So if you're looking for a ballast against an equity portfolio, bond funds are always going to provide that. They're not going to be rock stars in all environments. So they do serve a purpose in a portfolio. They'll still generate income, even if that income is a little bit lower due to falling bond prices when interest rates go up. So I think it's a depends on what your portfolio is using the bonds for time in the bond market.